Why?
Yeah. Funny story. Steve doesn't want me wearing these hat, but I think it's amazing.
Well, I think it's fun for like an event and it's fun for Instagram, right? Like, I
Oh,
mean,
I think so.
that's all
All
I'm
right.
saying.
So, Alan, we're going to talk about I got to take this silly hat off. I can't wear it.
If only you could like pass it through the ether.
That's
I
coming
would
out
wear
at
it in
the
a
event.
heartbeat.
Awesome, man. So we're going to talk about the fourth wealth commandment, which is that. What is that? What's the fourth wealth
The barbell
commandment?
strategy, asymmetric risk to the upside.
That's right. So what does that mean?
Yeah, it took me some time, and I was talking with Nick about this at the last Certainty Summit, and he made it a little clearer for me. I mean, really, it is more predictable, lower risk, or more predictable income, and I mean, moonshots would be the best way to say it in crypto terminology, right? Like it's like things that have like great potential. But so you don't need to invest a lot of money in them because they have such great potential. And then there's things that are, steadier income that you can count on. And so I look at it as like a rental is on one side because it's steady and stable, right? It's predictable in terms of roughly what income is going to come from that. But it's also limited, right? Because it's steady and you can have a certain amount, but like rents aren't going up 100% every year. So
Right.
you're not getting this crazy upside, but you're getting a steady income that's going to be, adjusted for inflation. It'll increase a little bit over time. And your value of your asset is appreciating over time. Whereas the other side is going to be much higher upside, but then it's also riskier. But because it's risky doesn't mean it's a bad thing. What it means, in my mind, is I don't have to invest as much into that upside because the potential's so big. And so I can take like $1,000 and put it into something that has huge potential, but it's not going to wreck me if I lose that $1,000, right? On the real estate side, in this example, like I have to put a lot more money into a rental in order to own it, but it's steady, it's stable. Like, I know what's going to happen with it more or less. And I can expect a certain level of return from it.
Yeah, exactly. And this is like an old concept. It was a Stoic philosopher, Seneca, who talked about this. Yeah,
yep.
good
Not
old Seneca. I got him right back here behind me. He's not one of these little guys over here. But no, this is so powerful. So like, what's the danger of loading the bar here? What is an example of like something that we load in the middle of the bar? Because the barbell strategy basically says we either want to be here on the steady, reliable side, or we want to take the bet here where we have massive upside and very little downside. And so It's not just that we have high upside, it's low downside. That's really the key here, right? So what is an example of where we might be loading the bar in the middle?
I mean, to me, it's where it's high downside and low upside, right? Like it's a situation where like I'm not getting the reliability and I'm also not getting the upside. So I've got bigger risks and I've got less upside to get. So I'm running the risk of losing more.
Yeah, no, I agree. I'm going to flip back to this because I want to talk just about like where are people loading the bar in the middle in their business, right? Mm-hmm. Let's forget about investing for a second because we're talking about, to business owners, right? So Where have you loaded the weight in the middle of the bar before?
I would say it's, I've done things like invested way too much on marketing that wasn't proven. Oh. So, didn't know what the upside really was, but the huge downside was all the money I was spending on the marketing. So that would be an example for me where like, it's like, well, that money wasn't really well spent because I had this hope. If I would have done it again, what I'd do is I'd take a smaller amount and micro step into some kind of new marketing thing that I haven't done before and see that it's proven. And then once it's proven, put in more money versus I'm going to take, 25,000, 50,000. I'm going to put it into this marketing and just hope that it goes up, and then in the end, didn't even pay for itself. So I think that's how business owners, or it could be something like, I have multiple product lines, but only one of them is really paying off. And the other ones are taking all my time and they're not actually breaking even. That would be another example of being in the middle, because it's not getting me, it's not predictable. It's not getting me a return that I want. And it's taking a lot of my time.
Yeah. No, marketing is one of those things that, like, anytime you do a new marketing channel, inherently it's on the upside side of the barbell. Like, it's not reliable because we've never used it yet. Now, I'm sure there's like, for my thing has always been direct mail. I've gone back and forth. It's like a love-hate relationship with direct mail, right? Like, why do I love to hate direct mail? Because I can spend $15,000 a month in direct mail in Denver. That's like shooting Nerf bullets, right? Like, you're going against folks who are spending $100,000, $250,000, and up on their direct mail campaign. So I can throw $15,000 out. Sometimes I get a deal.
Yeah.
Sometimes I get 2 deals, but there's also plenty of months where we get no deals, right? So we could spend 15, we might break even, we might make 15, we might even make more than that. But the downside is I also could just straight lose $15,000. To me, that's it's got upside as much as the downside. It's symmetric, so it's in the middle.
Yeah.
Another application for me is fix and flips. Some, and let me go back to the direct mail example. Some people, that might be on the reliable side of the barbell for them. They've done this for years. It's dialed, like it works. And the data, there's a preponderance of data, as Dan says, to indicate that we should continue doing this. Right. But let's take fix and flips again, for example. It's like, well, I am not good at fix and flips. So some of them can go well, some of them can go really poorly. So we talked about, the investor frame on a previous, video recorded. And I basically decided, it's like, well, if I'm loading the weight in the middle of the bar, what can I do to make it reliable or make it have high upside? And if I can't afford or, decide that doesn't get me closer to the things that I want, then I get rid of it. Have you done things similar to that in your business?
You know what makes me think of that? What pops into my head too is, I've often heard Nick say it, is one data point is not a trend.
Right.
So it really, like, going back to that preponderance of data to prove which side it's on, is really like when I have no proof, but I'm spending a ton of time, energy, or money on something, like that's the clue that, like, that is something that's in the middle of the barbell, because I don't have enough data to say, yes, I should be investing all this money in it or all this time in it, because I don't have any data to show. Or maybe I do coaching, and I got like one client from this new method. That's not enough data, right? Like, to say like that is the way that's going to work. So you have to be able to look at a trend of data and say, like, what's overall, what am I experiencing? That takes time and it takes commitment, right? And that's why I think, like, if it's unknown, then the time and the commitment is to maybe not spend a lot of money on it, but like maybe you're going to dedicate a little more time to it, and you're going to say, okay, for 6 months, I'm going to do this, and let me look at the data, and then let me make a decision, or 3 months. I mean, it doesn't matter what it just is. Like, don't look at 1 month or 1 week or one transaction and think that's going to prove something out when it comes to the barbell, because it doesn't.
Yeah, we need a preponderance of data in the absence of a preponderance of data, which basically means like 3 points make a trend line, right? Like, we need at least 3 points. And without that data, the answer is always to, one of the issue processors is to microstep, right? We take a microstep. We don't ape into a new coin we've never invested in. We don't ape into a new marketing channel that we have no data for, right? We want to microstep to gather that information, and it comes back to the case framework. So it's like you start to see all these things kind of come together, these principles, and they kind of all feed off of each other. And so it's been helpful to learn that.
The thing about this is, like, understanding that there are always multiple factors going into a decision. And I think that's what this certainty operating system really allows you to do, is to say, oh, okay, so let me go through all of these different steps to see a clear picture of what's happening. And it, like, if you're just like, I think you said it great. It's like, it takes 3 points to be a trend line. One point of data is not a trend, and you've got to be able to use the system to actually figure this out. It's not always intuitive until you get it. and then it becomes very intuitive, right?
Yeah, it's hard to unsee it once you've gotten like
Right.
familiar with it. And now this is the power of the Whale Club, right? Is that we've got a community that's with a shared language and a shared operating system. It allows us to shortcut things by like, we all know what we're saying when we say things like the barbell strategy and the investor frame and, you know, utilizing the case framework and, oh, you got a micro step. It's like, right. Without having that shared common language, it's tough to have these conversations. We have the benefit of being able to just make our point really quickly.
Yep. Absolutely.